Right now, while everyone is panicking and selling their stocks, Warren Buffett is doing something absolutely shocking. The 94-year-old billionaire is sitting on the largest cash pile in Berkshire Hathaway's entire history. And he just made a move that nobody saw coming. This is not a drill, people. The Oracle of Omaha is preparing for what could be the biggest buying opportunity since 2008. And today, I'm going to reveal exactly what he is buying and why this play could return over 420%. But here's the thing. Most investors will completely miss this opportunity because they are too busy watching their portfolios bleed red. If you stay until the end of this video, you will know exactly how to position yourself before the masses figure out what is happening. Welcome back to John Agal, and if you are new here, this is the channel where we break down the smartest money moves from billionaire investors so you can learn how to build real wealth. Before we dive deep into Buffett's secret strategy, do me a quick favor and smash that like button and hit subscribe. We are building a community of smart investors here, and I do not want you to miss the next big opportunity we uncover together. Now, let me show you something that will blow your mind. Warren Buffett has been selling stocks like crazy for the past several quarters. He dumped billions of dollars worth of Apple, Bank of America, and several other major holdings. And while mainstream media was calling him crazy, while so-called experts were saying he lost his touch, Buffett was quietly building up a cash position that now exceeds $330 billion. Let me put that into perspective for you. That is more cash than the entire market capitalization of companies like Netflix or AMD. That is more money sitting on the sidelines than most hedge funds manage in their entire existence. And here is what nobody is talking about. Buffett does not hold cash because he is scared. He holds cash because he sees opportunity coming. You see, throughout his entire career, Buffett has followed one simple pattern that has made him one of the richest people on the planet. He waits patiently while others are greedy, and then he buys aggressively when others are fearful. He did this in 1974 when the market crashed and everyone was running for the exits. He called it like shooting fish in a barrel. He did this again in 2008 when he invested $5 billion in Goldman Sachs during the financial crisis. That single investment made him over $3 billion in profit. And now all the signs suggest he is about to do it again, but this time on a scale we have never seen before. Let me explain what I mean by the $7 trillion crash. Right now, the stock market is trading at some of the highest valuations in history. The Shiller P/E ratio, which measures how expensive stocks are compared to their long-term earnings, is flashing warning signs that we have only seen twice before. Once during the dot-com bubble and once right before the 2008 crash. When you add up the total market capitalization that is at risk if we return to normal valuations, we're talking about a potential drop of $7 trillion or more. That is not fear-mongering, that is just basic math based on historical averages. Now, here is where it gets really interesting. Buffett has been quietly increasing his position in one specific sector that historically performs incredibly well during market downturns. And based on his track record, this sector has the potential to deliver returns of over 400% when the dust settles. But before I reveal what that sector is, I need you to understand why Buffett's timing is almost always perfect. You see, most investors think they can time the market by watching charts and reading news headlines, but Buffett plays a completely different game. He does not try to predict when the market will crash. Instead, he positions himself to take advantage of crashes whenever they happen. This is a crucial difference that most people miss. Buffett knows that he cannot predict the future, but he can prepare for it. And right now, his preparation is louder than any words he could possibly say. In his most recent shareholder letter, Buffett made a statement that sent chills down my spine. He said that wonderful opportunities come along rarely, and when they do, you need to be ready to act. He compared it to being a baseball batter who does not have to swing at every pitch. You can wait for the perfect pitch, the one right in your sweet spot, and then swing with everything you have got. The problem is, most investors are swinging at every pitch, depleting their cash and their patience long before the real opportunity arrives. So, what is the forward 20% play that Buffett is positioning for? Based on my research and analysis of Berkshire Hathaway's recent moves, I believe Buffett is betting big on three specific areas. First, he is loading up on short-term treasury bills. Right now, Berkshire holds over $150 billion in treasury bills that are earning around 5% annually with virtually zero risk. This means Buffett is getting paid to wait. He is earning billions of dollars in interest while he patiently waits for stock prices to fall. When they do fall, he will have an absolutely massive war chest ready to deploy. Second, and this is where it gets really exciting, Buffett has been quietly increasing his exposure to the energy sector. He has been buying shares of Accidental Petroleum for years now, and he shows no signs of stopping. Why energy? Because no matter what happens in the economy, people still need to heat their homes, drive their cars, and power their businesses. Energy is the lifeblood of civilization, and during market crashes, energy companies with strong balance sheets tend to hold up better than most other sectors. Plus, when the recovery comes, energy stocks often lead the way higher. But here is the third piece of the puzzle that almost nobody is talking about. Buffett is also positioning Berkshire to be a lender of last resort during the next crisis. During 2008, when banks were collapsing and credit markets were frozen, Buffett stepped in and provided emergency capital to companies like Goldman Sachs and General Electric. In exchange, he received preferred shares with massive dividend yields and warrants that allowed him to buy common stock at huge discounts. These deals made Berkshire billions of dollars in profit. The Goldman Sachs deal alone generated returns of over 400% when you factor in the dividends and the stock appreciation from the warrants. Now think about this. With over $300 billion in cash, Buffett is in an even stronger position today than he was in 2008. When the next crisis hits, and trust me, it will hit eventually, because that is just how markets work. Buffett will be able to write checks that no other investor can match. He will be able to rescue major corporations in exchange for sweetheart deals that guarantee massive returns. This is the 420% play that I believe Buffett is setting up. Let me walk you through how this could work in practice. Imagine a major company, let us call it Company X, gets into trouble during the next market downturn. Maybe their stock drops 50% and they cannot access credit markets to fund their operations. Buffett steps in and offers them $10 billion in emergency capital. In exchange, he gets preferred shares that pay a 10% annual dividend, plus warrants to buy the common stock at a price that is 50% below the current market value. When the market recovers and Company X stock goes back to its previous highs and beyond, Buffett's total return could easily exceed 400%. This is exactly what happened with Goldman Sachs, and there's no reason to think it will not happen again. Now, I know some of you watching are probably thinking, okay, this is great for Buffett, but how does this help me? I do not have $300 billion sitting around, and that is a fair point. But here's the thing. You do not need billions of dollars to follow Buffett's strategy. You just need to understand the principles behind what he is doing and apply them to your own situation. Principle number 1, always keep some cash on the sidelines. I know it is tempting to be fully invested all the time, especially when the market is going up, but having cash available when opportunities arise is one of the biggest advantages you can give yourself as an investor. Even if it is just 10 or 20% of your portfolio, that cash can be the difference between watching a crash happen and actually profiting from it. Principle number 2, focus on quality companies with strong balance sheets. Buffett does not buy junk. He buys businesses that generate consistent cash flow, have competitive advantages, and are run by competent managers. During market crashes, quality companies recover faster and often come out stronger on the other side. So instead of chasing speculative stocks, build a watch list of quality companies that you would love to own at the right price. Principle number 3, be patient. This might be the hardest principle of all, but it is absolutely crucial. Buffett has been building his cash position for years, not weeks or months. He is willing to sacrifice short-term returns in exchange for the potential of massive long-term gains. Most investors cannot do this because they are too focused on what is happening today. But if you can train yourself to think in years instead of days, you will have a huge advantage over the competition. Here at John A. Goal, we talk a lot about the psychology of investing because honestly, that is where most people fail. They know what they should do, but their emotions get in the way. They panic sell at the bottom and panic buy at the top. They chase hot stocks after they have already made their big moves. They give up on great companies just because the stock price went down for a few months. Buffett avoids all of these mistakes by sticking to his principles no matter what the market is doing. Let me share something really important with you. In 2008, when the market was crashing and everyone was certain the world was ending, Buffett wrote an op-ed in the New York Times titled "By American I Am." In that article, he explained that he was moving his personal money out of treasury bonds and into American stocks. He said that if you wait for the robins, spring will be over. He was telling everyone exactly what he was doing, and yet, most people were too scared to follow him. Those who did follow his advice and bought quality stocks during the crash made life-changing money in the years that followed. Fast forward to today, and we are seeing the same setup happening again. Buffett is not writing op-eds this time, but his actions are speaking louder than words ever could. He is selling overvalued stocks, building cash, and positioning himself for the next big opportunity. The question is, will you be ready when it comes? Now, I want to address something that I see in the comments all the time. People ask me, but what if the crash never comes? What if the market just keeps going up forever? And look, I understand that concern. Nobody wants to miss out on gains by sitting in cash for too long. But here's the reality. Crashes always come eventually. It is not a matter of if, it is a matter of when. And more importantly, even if the market continues going up for another year or two, having some cash available is never a bad thing. Buffett has been building cash for several years now, and yes, he has missed some of the upside, but he also sleeps well at night, knowing that he is prepared for whatever comes next. The other thing I want to mention is that Buffett is not sitting completely in cash. Berkshire still owns massive stakes in incredible businesses like Coca-Cola, American Express, and the entire BNSF Railroad. These are companies that generate billions of dollars in cash flow year after year, regardless of what the stock market is doing. So even while Buffett is building his cash position, he is still collecting dividends and watching his businesses grow. This is the beauty of owning quality companies. They pay you to wait. Let me give you some specific numbers to think about. If the market drops 30% from current levels, which is not at all unreasonable based on historical patterns, that would represent a loss of about $7 trillion in total market value. But for investors with cash on the sidelines, a 30% drop would represent a massive buying opportunity. You could buy the same shares of great companies for 70 cents on the dollar, and when the market eventually recovers, which it always does, you would be looking at gains of 40% or more just to get back to even. If you then hold for several more years as the market continues to grow, your total returns could easily exceed 400%. This is the math that Buffett is doing in his head every single day. He's not thinking about what the stock market will do tomorrow or next week. He's thinking about where will these companies be in 10 or 20 years, and what is the best price I can pay for them today. This long-term thinking is what separates him from 99% of other investors. I also want to talk briefly about the sectors that Buffett is avoiding because this tells us just as much as the sectors he's buying. Over the past few years, Buffett has been trimming his positions in technology stocks, including his massive stake in Apple. Now, Apple is still Berkshire's largest holding, but it is much smaller than it used to be. This suggests that Buffett thinks tech stocks are overvalued relative to other opportunities. He's also been selling bank stocks, which could indicate concerns about the financial sector heading into a potential recession. On the flip side, Buffett has been adding to his positions in energy, particularly oil and gas producers. He has also maintained his large stakes in insurance companies, which is interesting because insurance companies generate huge amounts of cash that can be deployed during market downturns. This all fits the pattern of someone who is preparing for volatility and looking to take advantage of lower prices when they arrive. Before I wrap up today's video, I want to hear from you in the comments. What do you think about Buffett's current strategy? Are you building cash like he is, or are you staying fully invested? Do you think the crash is coming soon, or do you think the market has more room to run? Drop your thoughts below because I read every single comment, and I love hearing different perspectives from this community. Also, if you found this video valuable, please share it with someone who needs to hear this message. There are so many people out there who are about to get caught off guard by what is coming, and maybe this video can help them prepare. Remember, the goal here at John AG Goal is not to scare you or make you panic. The goal is to help you think like the best investors in the world so you can make smarter decisions with your money. Buffett is not scared of what is coming. He is excited about it because he knows that market crashes create the best opportunities to build wealth. And if you position yourself correctly, you can be excited too. Thank you so much for watching all the way to the end. That tells me you are serious about your financial future, and I really appreciate you being here. Make sure you subscribe if you have not already and hit that bell icon so you never miss a video. I will see you in the next.